Well, hi there. My name is Jason Ayers, Chief Executive Officer at Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for June 2019. Well, almost like clockwork, both Canadian and U.S. stock markets began to sell off the 1st of May, lending some credibility to the adage, sell in May and go away. Was this a self-fulfilling prophecy, or just the byproduct of an overbought market hypersensitive to trade war headlines and Trump's Twitter feed? Regardless of the reason, the major Canadian and U.S. stock market indices spent the entire month of May in a downtrend, although it is worth noting that Canadian stocks outperformed their U.S. counterparts, with Canadian technology, utilities, and consumer staples showing modest gains. As we highlighted in our Portfolio Manager's Brief last month, we were expecting a snapback as stock prices continued to stretch into all-time highs during the month of April, and we were positioned accordingly throughout May as markets corrected. While we do expect that trade war headlines will continue to drive market volatility both here and abroad, we don't believe that has anything to do with the imposed tariffs. Once tariffs are announced, share prices of impacted companies seem to adjust very quickly and efficiently. What we believe investors are currently grappling with is the uncertainty that comes from the cascading effects of tariffs on growth, production shifts, pricing power changes, investment, and employment. All that said, economic data continues to show strength, and stocks seem to have found a short-term bottom based on the reversal in markets the first week of June, suggesting that until economic fundamentals deteriorate, markets will be supported despite the uncertainty. Our more conservative portfolios continue to hold high-quality companies that appear to be trading at discounted share prices compared to their underlying fundamentals. We also continue to include strategies and assets that are negatively correlated to the stock market in general, which helps minimize portfolio volatility, along with an active option writing overlay to enhance cash flow. A similar approach is being applied in our growth-oriented portfolios. While we still anticipate stock market upside, it's going to be a bumpy ride, and uncertainty will remain a headwind. This tends to lead to more range-bound share prices and higher option premiums, which is ideal for active management and increased option writing as stock prices bounce between key support and resistance levels. Defensiveness remains the overall theme for the firm's approach to managing investments across all risk levels. This includes active profit-taking, holding higher levels of cash, the utilization of hedges, and a discriminating security selection process, as well as patience when looking for entry points on stocks on our watch list. While economic data remains supportive and stock markets are a long way from the December 2018 lows, we can't discount what's been happening in the bond market as the yield curve inversions in both Canada and the U.S. suggest an aging business cycle based on historical evidence. We are maintaining our outlook for modest growth over the next 12 months, but as more investors and money managers move into longer-dated bonds, the possibility of a recession remains a risk, and the stock market will continue to be sensitive. To summarize, we will stay the defensive course despite how tempting the stock market uptrend looks until our analysis of economic conditions and the geopolitical landscape suggest otherwise.